Spreads are an incredibly powerful tool that can let you get a lot of money out of the stock market. They're personally one of my favorite strategies, and I use them all the time. The reason I really like spreads is that they're a mix between buying naked options and dealing with stocks. And when I say that, I'm talking about risk reward. Generally, you're going to be getting much higher return on spreads than you are just dealing with stocks. However, your risk is going to be higher, but not as high as maybe dealing with naked options trading. Spreads are a more advanced strategy, so if you're not familiar with options, I have a video explaining the basics of options and the very basics of spreads. I highly recommend you watch that if you want to get into the details of this video, because if you don't understand options at all, you won't get much out of this video. The website I'm currently on is Options Profit Calculator. This is a fantastic website. I use it all the time. It's great for evaluating tons of strategies and visually seeing their performance on a chart. The first spread we're going to talk about is the put spread. The put spread involves buying a put and selling a put, and you make the difference of the values of the puts. Let me give an example. I'm going to use everyone's favorite meme stock, Tesla, and currently it's trading at $406. I don't like to use the term betting, but for the sake of simple language, a put spread is about betting that a stock will not go below a certain price. You are wagering that the stock will not go below a certain price. When we click select option, in the case of this website, puts are over on the right-hand side. And I'm going to use the 6th of November as my example. Now, recall, puts are only valuable if the stock is below the strike price on the put. Right now, Tesla's trading at $406, so we're going to be dealing with out-of-the-money puts. You can make a put spread that is in the money if you are very bullish on a stock, if you think it's going to soar past that, but we'll discuss more of that later. Right now, we're going to be dealing with out-of-the-money prices. Let's say by November 6th, we are convinced that Tesla will not go below, let's say, $385. Now, if we want to make that wager, the end that we buy actually needs to be lower than that, because the whole reason for buying a put is that we use it to hedge our maximum loss. Let me calculate this and show you visually. I'm going to select $385 for our buy, November 6th, and now I'm going to go to $390 for our sell or right. If we calculate our graph, this is what we get. This is the current trading price of Tesla. Tesla stays above this $390 number, then we end up making money. If Tesla goes below that amount, then we lose money. However, you'll notice that we have a maximum risk, the maximum amount we can lose, because we own a put. Since we own a put, we could always execute it if Tesla plummets below that 390 and goes lower than 385. Now, it costs money to buy a put, but because we're closer to being in the money with the one that we sell, we make the difference between the two. In this case, it costs $773 to buy the put, but we make $960 selling it. So our maximum return is $187, with our maximum risk being $313. Now you might ask, hey, isn't the difference between $390 and $385 $5? And for an options contract, that's 100 shares, so isn't the max risk $500? You are at risk of losing $500, but remember, you're selling one. So you're collecting premium. Every time you sell an option, you collect premium. So once we get this $960 of premium, we could calculate our maximum risk by subtracting that $500. In this case, that's how we get our maximum risk. And again, you're essentially making a wager that Tesla won't fall below this value. Maybe to get a better representation, we can choose something even farther out. Let's do the 20th of November, and let's experiment with selling an out-of-the-money spread. Let's say that we are very bullish on Tesla. Well, we see it's trading at $406, so if we sell something out of the money, let's say 420 for our buy. And remember, our sell has to be farther away. We have to change the date. Let's do another difference of $5. So when you take a look at our chart, if Tesla stock stays completely flat, well, we're going to hit our maximum loss. If it actually does surge up in value, we make money. And we have a small amount of loss here, a larger gain here, and then our maximum gain. This all gets a little segmented, but that's the nature of the beast when you're dealing with these differences. And theoretically, you can have an even larger difference if you really want. Instead of doing a difference of $5 in strike price, we could do a difference of $10 in strike price. So we have 420. Now let's select 430. And we see, in this case, our maximum return is significantly higher. However, our maximum risk is significantly larger as well. And that's the nature of the beast when you're dealing with spreads. You are making money off a differential. The larger the differential, the more money you make. However, your maximum risk increases. And that's one of the beauties about spreads, is you can heavily customize them to meet your need. You can do a lot of finagling when it comes to dates, strike prices, differential, all of that. You basically just put in whatever values you want until you receive a profit loss chart that you like. If this looks realistic to you, if you're like, oh yeah, by November 18th, Tesla's going to be $430, then absolutely, this would be a great position. If this chart scares you and you're like, well, I'm not sure they will actually be that high by expiration, then yeah, it's rather unfortunate. You might have noticed these early profits, and you might be asking yourself, how can you make money before they expire? Remember that options are all about probability. If you sold this spread and Tesla skyrocketed in value, then it's going to be way less likely that they're just going to absolutely plummet. The value of these options is changing constantly. This is what we bought at, this is what we sold at, but as Tesla stock moves, the value of these options at these strike prices and expiration dates is going to move as well. If we see a massive dip, Tesla needs to gain a lot to actually recover and make those options worth anything. So you can always sell out of your positions early. In this case, you would buy to open and you would sell to open. If you want to get out of your position, you would sell to close and then buy to close. And the reason for that is if you have an option sold, you are out on the hook for that option. If you own an option, you just need to sell it. You need to cancel out this option that you have sold by buying an identical one, hence buy to close. Also, keep in mind, if you are selling options that are in the money, like this spread we just created, this put spread, if you're selling this, you are taking on early assignment risk. You sold something that someone could exercise and get their shares. It is in the money. It technically it doesn't make a whole lot of sense to exercise, but maybe if the stock moves up slightly and they just want those stocks, or there's earnings with a dividend, other things like that, you are opening yourself up to risk of early assignment. And that's something to consider. If you're dealing with American-style options, that's how they all are. If you're dealing with European-style options, like you see on indexes typically, then those can only be assigned and exercised at expiration. But in the case of something like Tesla options, someone could exercise your option. Now, they could exercise an out-of-the-money one as well, but all that would do is make you money. So it doesn't really make much sense to do that. Now, much like a put spread, there are call spreads, and they are exactly the same as put spreads except inverted. You are hedging or betting that a stock will not go above a specific price. Again, let's pick our favorite friend, our favorite meme stock, Tesla, and in this case, let's pick the 13th again. Now, notice that this is inverted. Calls are valuable when the stock is above the strike price. So, generally, you want to sell an out-of-the-money call. Right now, it's trading at 406, so it's the opposite of a put. You would be picking something higher than 406. In this case, let's go with 420 for our buy. Now, we need to sell a call. Although you have to realize this is inverted from put spreads. As you get farther and farther out, these options get less valuable. So instead of buying something farther out like you would with the put side, you actually want to buy something closer to being in the money. So if you're buying 420, you need to sell something closer. Let's do a difference of 415. And we can see it looks almost identical to the put spread, except it is completely flipped on its head. In this case, you are being bearish on a stock. And that's sort of the beauty of spreads. You can manipulate when they expire. You can manipulate the strike price. You can manipulate whether you want to do a put or call. You can change everything about this graph until you get one that you are comfortable with. In some cases, you could go crazy far out of the money, right? Maybe we could buy a 470 and then we could sell a 460, but then you have to realize that your maximum risk is $878 and your maximum return is $122. This is a much lighter chart, and you might feel comfortable with something like this. You are taking on a pretty large amount of risk for a smaller amount of money. It is all about what you feel comfortable with, but one of the reasons I really like put and call spreads and spreads in general is that you can make a pretty decent return. You are only ever putting your maximum risk on hold. So this would sort of be like putting $878 into stocks. And then over the course of a couple weeks, you make $122, which is 13.9% return over a few weeks. Now, how many stocks are going to be giving you that? And keep in mind, this is with a really absurd, far out of the money spread. If we go to something a little more reasonable, like 430 and 435, we can see that our maximum return is a bit higher and our maximum risk is far lower. And in this case, we're making 59.2% over the course of a few weeks. How many stocks have you purchased that have gone up over 50% in a couple weeks? Now, that's with the assumption that you aren't wrong and you don't hit maximum risk and lose a bunch of money. Again, you have increased risk, especially when the market is very volatile and crazy. You can make serious returns using this strategy. When I was starting out in the market, this really was my favorite strategy. If you're just dealing with stocks, it is difficult to double your money. If you're dealing with options, you could get crazy returns, but it's incredibly risky. And one bad options play, if you spend a couple thousand on an option and you only have a couple thousand in your bank account, well, that expires worthless, and that's a huge hit that's difficult to make up. With spreads, I've gotten into positions that I feel very comfortable with and that I almost always make money on consistently. If you really want to accelerate the growth of your account, this is a useful strategy. It's a riskier strategy, true, but if you are good with them, you can get a far larger return than you can playing very volatile, risky stocks at a similar amount of risk. And in general, that's my preferred strategy, playing options on more solidified stocks rather than dabbling with risky stocks. It's a similar amount of risk, but I feel more comfortable doing the latter. If you want to jump into the stock market and start investing, I have a referral link in the description for Webull. If you sign up, you'll get 2 free stocks and have access to a fantastic mobile and web app.